Good afternoon, everyone. Find your seats. We'll get started in just a second. I'm happy to welcome to the stage Andreas Clenow. He comes from us. He is originally from Sweden. He lives in Zurich. He did his early work for Reuters doing equities, and he has since become a founder of more than one hedge fund. He's also a prolific author, including 2 books, Stocks on the Move, and oh shoot, did I just screw? Oh my. The Things You Try to Do from Memory, Stocks on the Move and Following the Trend. Thank you very much.
All right, so I'm the guy here to speak about monkeys. I'm sure this topic raises a few eyebrows, but don't worry, I am getting to a serious point at some part of this presentation. Well, trade like a monkey, trade like a chimp. Well, sorry, when I look down, it's way too loud. Sorry, I just realized that. Obviously, this topic is about portfolio modeling. Portfolio modeling is a little bit different from traditional technical analysis type systems where people look at one market, try to find the best entry points, exit points, and so on for a market. That's usually what you read about in retail literature. In portfolio modeling, we don't really care so much about the individual stock, individual portfolio component. It's all about the end result, how they work together. Therefore, portfolio models are usually not as obsessed with the exact entry, the exact exit, stop losses, and other terminology that usually is more related to traditional type of trading models. Portfolio models, we need a couple of different components first. Don't worry, I'll get to the monkeys. We need to have a stock selection mechanism. We're dealing with stocks here, obviously, this presentation. So we need some criteria for how to select which stocks we are going to buy, how we build a portfolio. We need to allocate to our portfolio. How much do we buy of each? Simple solution, of course, buy equal amount of each, but that's usually not the most clever idea. We need to rebalance because otherwise our portfolio will go out of whack after a while. If you start off a year, for instance, with 70% stocks and 30% bonds, you wait 2 months, well, you no longer have 70% stocks and 30% bonds unless everything moved the exact same amount, and that's not going to happen. Most importantly here, we have the benchmarking, the classic problem. In stock world, well, most of us, we work with benchmarks. On the hedge fund side, some of us we don't. The benchmark could be the 0 line, but traditionally it's an index of some sort. So we have to compare to it. Maybe you're closely benchmarked, maybe you have a tight tracking error budget, or maybe you don't, but the benchmark does matter. So let's look at the benchmark first. It's not too inspiring, is it? So we had this big bull run here, and you still hear the classic views after this that stocks always go up in the long run. And of course they do, but does the long run matter if the long run is this long? Here we had a 10-year period with no returns at all, and at one point we lost over half the money. That's not a very attractive trading model. For 15-year period, extended 5 more years, we get a nice bull market. Well, we only compounded 5% a year, and we still had that drawdown of over half. Now, just investing in the index doesn't seem to be the solution. If you happen to live in the right era with the right type of bull market, it's fine, but that's quite a gamble. Maybe mutual funds are the answer. Or maybe they're not. So this data is from the SPIVA report. It's the S&P 500 index versus active report. They measure which mutual funds manage to beat the benchmark or live up to the benchmark. Mutual funds, of course, have one single purpose, to match or beat the benchmark. As it turns out, any given period, 3, 5, 10 years, you have 80-85% of funds failing to beat the benchmarks. This is not the fault of the fund manager. This is the fault of the model of mutual funds. I'm not going to spend too much time on that. You all know the problem of mutual funds, and that's why the industry is increasingly moving away from them. But obviously, we have a problem here. Investing with the index, even if we can buy the index as it is, it's not terribly attractive. If we buy the mutual funds, well, we get even worse. So we got at least an 80-85% probability of getting something worse than the index. And this brings up the obvious question. How can the chimps help? So we have academic research and empirical observation supporting my thesis. So See, Professor Malkiel once wrote famously in the Random Walk Down Wall Street that a blindfolded monkey throwing darts at a board, throwing darts at a list of stocks on the financial papers can outperform a group of carefully selected experts. I think that statement is somewhat unfair, because what are we really accomplishing by blindfolding the monkey? We are worried that he's going to aim at the right stocks. But empirical observation does prove the point that monkeys know how to select stocks. You see, in 1993, I was in the beginning of my financial career in Sweden. We had this prestigious competition of selecting stocks beginning of every year. These are not retail people, hobby people who are competing in this. These are the top investment houses in Scandinavia. A very prestigious competition. Normally, the biggest, the most famous investment houses and their top analysts win. 1993, the local Stockholm Zoo, they entered Ola the Ape into the competition. Ola the Ape walked home with a victory. Now, incidentally, that turned out very bad for Ola the Ape, because a couple of years later, he disappeared from the zoo and no one really knew where he ended up. 10 years later, we all saw the headlines that for various reasons that no one could explain, he was sold to some zoo in Thailand where he was not treated very well. We have no idea how that happened, but he probably upset the wrong people. Now, unfortunately, Quantopian has denied my request to actually bring a monkey here. Apparently, there's some sort of New York regulation about primates throwing pointy objects in crowded areas. So we're going to have to replace them with a random number generator instead. We try a couple of strategies just to prove my point here, because you all think I'm kidding, but maybe I am, but it does have a point. Strategy number one here, random stock picking. You heard this one before. This is not new. I'll get to the new things. Here we pick at the beginning of every month. We liquidate the whole portfolio, sell everything. We pick 50 random stocks. A number generator selects 50 stocks. Put equal amount of money in each of them. Next month, sell everything, do it again. Of course, we only pick stocks from the S&P 500 members, and the important part is we, of course, pick from those stocks that were a member at the time. We have to take the historical membership into account, otherwise this would not be a fair comparison. How did this do? Well, not too bad. The white line you see here is the S&P 500 total return. That means you have the dividends in there. That's all the return you get. This white line is, of course, much better than the normal S&P price index, which does not include dividends. And still, the chimps did pretty well. Sure, we got quite a span between the best one and the worst one, but none of them are even close to performing as poorly as the index. Clearly something is going on here. Let's push this a step further. Now we have random stocks at random weights. So before we put equal amount in every stock, if we have $1 million portfolio, we just divide the million with the 50 stocks, equal amount of cash in each of them. But the question is, would a monkey really invest like that? He would probably throw the darts for that too. So here we have no constraints at all. We could have 99.9% in one stock. Could be any weights at all. And this is, of course, reset every month again. We pick new stocks at new random weights. We got a larger spread. Some of these lines, they had large drawdowns. They had quite a lot of volatility, but they performed. They did better than the index. Random stocks, random weights works fine. Can we push this any further? What else can we do? Well, how about if we have a random number of stocks? So we pick from the S&P 500. We pick a number of stocks anywhere between 5 and 300. Why not now going to 1 and 500? Well, that would just be silly. So we still have a portfolio, 5 to 300 stocks, by the monthly, at completely random allocation. Let it land where it lands. Now, clearly, this can't work. It actually does. Yes, I did do the simulations properly. I'm sure someone is wondering if I really did this math properly, and you're happy to verify it. You'll get very similar results. Here you see some really wild behavior, mostly because sometimes you end up with portfolios with very few stocks, and then anything can happen. You see sudden drops when something major happened in one stock that maybe it had 90% of the portfolio at that time, but overall, even this outperformed the index over this particular period. In all fairness, I should point out that much of this outperformance comes from this period where large caps did very poorly. And that brings us to the point of, no, it does not yet. We summarize the strategy first. Almost skipped the slide there. These are the rules we come up with. We have a completely random portfolio with a random number of stocks. And these are all the rules you need to beat the index. So why are fund managers not doing this? Or why are they not outperforming? Well, the problem is, this is what I'm getting at. This is the main problem. Not the only problem, this is the main problem. Market cap weight. The S&P 500 is my benchmark here. We all know S&P 500 has 500 stocks. That's in the name. But does it really? The top 10 stocks have the same weight as the bottom 300. There's about 18% weight for the top 10 stocks in the index and about 18% weight for the bottom 300 stocks. So why are we pretending this is an index with 500 stocks? It doesn't matter. The bottom 300 stocks are completely irrelevant. We are just buying a handful of large caps, massive companies. And of course, if you buy Apple, Apple has an approximate market cap value of the GDP of Switzerland, where I currently live. Then the question is, can that stock double again? Well, maybe it can, but can it triple? Can it go up 4 times? We start hitting some sort of natural limits here. And don't forget that these stocks are in there because they were once small, they had an enormous run-up in value and price. That's how they entered the index to begin with. The S&P 500 is, in a way, a momentum index. Stocks are there because they had great performance in the past. That's why it's a type of momentum index with a very strange weighting scheme that doesn't fit normal momentum schemes, but it's a momentum index. Now this pie chart here just shows, it divides the index members in pieces of 25 stocks each. The top 25%, this piece, next 25 stocks. So you compare these 25 stocks with the ones over here, and you see that it's not a diversified index, and thereby there is the problem. So you could do either equal weighted, the monkeys did that before, or I show the random weighted. Random weighted, obviously, you don't want to do, but it still works. What would make a bit more sense could be weighting on other factors. But let's look first at this one. This is just isolating the effect of just the market cap issue. See the bottom line here, this one, that is the index you're used to, plus the dividends. This is the S&P 500 total return index. The top one is a total return equal weighted index. It's also issued by the S&P, the official index. There's even ETFs on it. This just buys the same amount puts the same amount of money in each of the stocks. And yes, it hasn't always outperformed, not every year, but it outperforms over time. It has always outperformed over a longer period of time, and it makes perfect sense. It's not as big outperformance as a random strategy, though. So we only explain part of the issue. But maybe we can wait on something else instead. And my personal favorite, which is quite common on my part of the business, is weight by volatility. It's really quite simple. You find some sort of measurement of volatility. Which one doesn't particularly matter. Pick a simple one. Pick ATR if you like. It's one of the simplest estimators. I wanted to put risk parity here just to see if any of the quants in the audience would pick a fight with me, but I replaced it with volatility parity, which is actually more correct. The term risk is a trick you want to use in a quant crowd. So this is volatility parity. We look at short-term volatility here, a month back or something like this. I believe I did. Then we weight the stock allocation on the inverse volatility. That means that a stock that's more volatile, we allocate less money to it. Because if we allocate the same amount of money to each stock, it just means that the most volatile stocks will take over the portfolio. If you put $1 million in a slow-moving utility and $1 million in a high volatility biotech, that portfolio is going to be driven by the biotech. And what I want to accomplish here is to have each stock given an equal potential vote to the portfolio. I don't want to weight my portfolio or gear the portfolio towards the volatile issues. So we're picking each equal. This simulation you're looking at here picks 50 random stocks again, back to that, but at volatility parity. This is the best performing random strategy you've seen yet. And based on this, we know that we can, with such a methodology, outperform the index. But obviously, we're not going to go tell our clients that we're going to get a random number generator to pick the stocks. So we have to figure out a way to end up among one of the better lines here and still have a sane enough story about what we do for a living. So the mission is to be the better primate. We need to build a portfolio model which can take the best parts of the random strategy and make it into a slightly more sane strategy. Portfolio model is usually constructed of these pieces. We need to figure out the investable universe. Where do we start? We can't start with every stock in the world. We have to narrow it down somehow. We need to screen for certain criteria, get rid of certain stocks that we don't like. Rank the stocks on the criteria. That's a key point. Pick criteria that we rank the stocks on. We select the top stocks and we figure out a way to allocate to them, and we repeat. Again, the rebalance, a necessary part of the portfolio. Otherwise, it doesn't take long before all the nice portfolio design you did to begin with is gone with different price movements that pushes the weights out of place. So you have the classic factors that you can pick stocks by. You all know these ones, and frankly, at this point, you probably start recognizing. You probably, if you work in the business, have lots of people pitching you these kind of things at the moment. Separate products, separate ETFs, for instance, that buy stocks based on these value factors, dividend yield factors, quality factors, or momentum factors. There are a few other ones, but these are the big ones. Now, I'm going to pick one of them, completely at random, has no relation to the fact that I just wrote a book about one of them. We're going to pick momentum. I also have another good reason, and that is that momentum of all of these are easiest to quantify. We're just dealing with price here. The other ones can be quantified, but the data is not as easily accessible. You have more concerns with data cleaning, with making time series and so on. And besides momentum, you could do it directly on the Quantopian platform as well. So isn't it just factor investing? And yes, of course it is. Factor investing has become more and more of a buzzword in the industry lately. I'm sure you get enough people pitching you this. I'm not going to go in and pitch this any further. But factor investing, or sometimes called smart beta, alternative beta, all kinds of other names they make up to be unique, but it's basically the same thing. It's about building simple portfolio models. Nothing clever, nothing too unique. Usually you pick a simple way to isolate a certain factor. It makes for a nice, clean story, a nice, clean portfolio component for the allocator. You have an alternative weighting scheme, an alternative selection scheme, and it's really not difficult things, but it makes perfect sense. No more market cap weighting. So here's the model we try it. Investable universe. We stick with S&P 500. We can do it on many indices, but we have to pick something here, at least for this presentation, and that's a good index to try to beat. We screen them by making sure that stocks has to be current members of the index. Important point here, if you model this, is you have to take into account the so-called graveyard. You have to look at what stocks were members of the index at the time, even if they are delisted, merged, changed, otherwise. That means you can forget about using Yahoo Finance and similar because it doesn't cut it. You need a quality data source. We have to have positive momentum. We don't buy momentum stocks if there are no momentum stocks to buy. So we kick out any stocks that's just not moving up. We rank these stocks based on the Clenow momentum. I'm only half serious about that name, but anyway, I will get to what that is. We select from the top stocks on the Clenow momentum. Volatility parity sizing. simplistic model. Don't worry, all this source code for whatever I'm going to show you here will be available. It's still already available on Quantopian site. We rebalance monthly. So this is a fairly slow trading model, buying stocks that move up. Now the Clenow momentum, what is this really? Well, it's not so complicated. It's just a variation of ways to measure momentum. Now you could measure momentum in a simple way. How many percent does something move up in a month? How many percent did it move up in 2 months? But I prefer a little bit different way. Complicated words, but we've got a quant crowd here, so you shouldn't be concerned. Annualized exponential regression slope is the basis for my analytic here. Well, I'll get to exactly what that means, but you take this annualized exponential regression slope, you multiply it by the coefficient of determination, the R square, and you get my little number. The exponential regression, I'm sure you're familiar with the concept, but briefly. Linear regression measures best fit line and how much that tilts up and down, the slope of this line, in this case per day if we're looking at daily stock data. Now the problem with linear regression here is that we get the answer in dollars or cents. You can compare that across different stocks. It means something very different if the stock is trading at 200 or if it's traded at 50. So we need to use exponential regression that measures the slope in percent. Then we can compare it across different stocks, regardless of their base price. The annualized, well, the problem with the regression analytic is you get a number that's very difficult to relate to. You might get a slope of 0.0025% per day. Remembering the amount of zeros and relating to this number is not so easy. So it doesn't accomplish anything from an analytical point of view, but we annualize it, assuming 250 trading days a year, and look at what would this imply on a yearly basis. Now the number we get then is, it answers the question, how many percent would this stock move up in a full year, assuming it continues the exact same path as it did in the recent past. Now we're not believing that's going to happen, but it puts a number into context. Then we understand how much is it really moving up and down. Oh, just to mention as well here maybe, if you got a linear scale on a chart, then the linear regression line would look straight. Although if you got a log scale on your chart, well then the exponential regression line would look straight. So if you're looking at charts a lot, you can probably relate easier to that explanation. Coefficient of determination. It fits very well together with regression. See, I mentioned that the regression slope tells you the slope of the best fit line. The R square, or the coefficient of determination, tells you how well does that line really fit. You can always calculate a regression line, even if the data has no direction or path or relation to each other at all. But then you get a very low R square. If you got the points all over the place like this, you get a low R square number, is a poor fit. You get a number near 0. If you got a very nice fit, you get a number near 1, which is the maximum value. Now, since we have a number between 1 and 0 that tells you how well the line fits, well, we can just multiply it. The reason we multiply it is that then we punish those stocks that are all over the place. If, for instance, there's very high momentum because there was a takeover offer, price just jumped 100% in a day, well, that's going to push the R square down dramatically, and we multiply our high regression with a low R square, and we end up with a low number in the end. So we get rid of some of the silly situations from this, and we get the much more firm, slow ascent instead. So here we are with a variance model. This model starts with S&P 500. It ranks on this momentum number I'm talking about. It has a minimum. We put a floor to this number. Any stock that has a value Less than 30, we don't even want to consider. Mainly because if we allow any value there, we end up with stocks with a negative number in a bear market. If all the stocks are in a bear market, like happened in 2008, there is nothing positive to choose from. Why 30? Well, you can pick at a number. Pick 20. It doesn't make a big deal of difference. Experiment with it. There's a source code is available. And we also make sure here as a fail-safe that a stock to be included has to be in the top 20% of the stocks available. So we look at all the S&P 500 stocks, we rank them, and the stock has to have a positive momentum, and it has to be in the top 20%. And remember, we do this rebalancing, right? So if any of this changes over time, say stock is no longer part of the S&P of the S&P 500 index, no longer part of the top 20% in the index ranked on this number, or if it doesn't have a momentum value of 30 or better, it goes out in rebalancing action. The rebalancing as well, maybe I didn't mention that properly before, it not only makes sure we have the right stocks, as in kicking out the stocks that no longer fulfill our criteria, and including new stocks that do, it also resets the position sizing. And that's a very important part of portfolio models, that you always have to reset the position size over time. Even if you do an equal weighted strategy, you have to do this rebalancing, otherwise you end up with a very odd portfolio over time. So we rank the stocks based on this number. We make a ranking list. This is something that's very easy to build. You can build in Excel even. Not that I recommend Excel, because that's not the most stable environment to do it in. It's a nice environment to output the data to, so you can visually inspect it and work with it, but doing the math there is not the most stable. We buy from the top until we run out of capital. So there's no leverage at all in this strategy, and if there are enough available stocks that fulfill our criteria, well, we just keep buying until we are completely out of cash. We allocate again according to the inverse vola. In this case, this implementation, we use a 20-day ATR. 20-day because that covers the last month, basically, and next month we base the ATR on the previous month and rebalance the size again. Once a month, we look at the results and rebalance. Only once a month. This is a pretty slow trading strategy. Here are the results for that model. What you're looking at here is, again, the same line, the S&P 500 total return. And the top line shows this momentum strategy. This is calculated on the Quantopian website, by the way, with this code that is already in the forum. So you can replicate the exact model there. What you see here is, first, it performs quite well. It outperforms quite nicely. It has a much lower drawdown. Now, the reason it has a much lower drawdown is the screening criteria, that we require positive sloping stocks. That also means that during some bear markets, only severe bear markets, we start building up cash in this strategy. So if you have a concern with not being invested, well, then it doesn't work. Well, it does work, but not as well. Then again, buying stocks when all stocks out there are falling like knives, well, that might not be the best idea, regardless of what type of strategy you're implementing. Some of the outperformance here obviously comes from this. But as you see, we are slowly outperforming in the other areas as well. In the past year, well, okay, maybe not, but any given year, anything can happen. So this is the Quantopian simulation, and no, I didn't include this so you can look at the exact numbers. You happen to do so, but this single screenshot doesn't, it's not that easy to see what's going on, but it's all out there, it's on the forums, and I'm happy to answer questions there with ideas on how you can modify it as well. But there's one interesting question left here, and that's, we know that this strategy can perform. We know that we can outperform the index. But the question is, well, how are we doing against the monkeys? Because after all, if this model doesn't outperform the monkeys, then we have a problem. Then we just spend all this time when we can just run a random number generator instead. Here's the result. White line again, S&P 500, the worst performer. The blue lines you see here, various shades of blue, those are the best monkeys we saw before. The volatility parity, selecting 50 stocks, monthly rebalancing. Black line is us, the new strategy. Many times we are leading, especially we have much lower drawdowns. Even if you eliminate the rule of putting the floor on the analytic and essentially agree to buy negative volatility, the least bad volatility during bear markets, you would still see an outperformance, but not as much here. Then, of course, as you notice, we were pretty good here for a while, but we were okay, but we weren't the best. A couple of clever chimps, I think 3 or 4 of them in this simulation. What you're looking here is 50 runs. Of each of these random simulations, I showed 50 runs. I did 500 of each, but frankly, that looks quite silly on a chart. So I included 50 random selection out of the random models, making sure that you get both the best and the worst in there, so you get the full span.
Do you have the chip average?
Sorry?
Do you have the chip average?
No, but I can get it for you. Not at the moment. But they're doing quite well. So, so I guess after all of this, getting to the final points, you have to wonder what the point here is. And well, the first point is that random modeling can actually be helpful. It reveals the weakness of the index itself. Indices were created to begin with to measure the health of the stock markets, and as such, it makes sense. It's not the fault of the indices. They were not designed as investment strategies. Making investment strategies based on them, well, that made sense when they started doing that. There was a rise of the mutual funds in 60s, 70s, I would guess. It was before I was in the industry, obviously. It made perfect sense. Before that, you couldn't invest in the broad markets in any other way, and following the indices made sense then. It does not make sense now. Indices are great. Look at the indices to see what the stock market is doing, the health of the market, so on, the health of the economy. But as investment strategies, no. The random monkey strategies show us just how weak these models are, or these indices are. So creating these random simulations, it actually has a point because it gives you the overview of what would have happened from purely random view. Then you can benchmark your strategy against it. If you develop a really nice model, you have lots of rules in there, you run your simulations, you see that you clearly outperform the market, you're very happy with your strategy, well, give it a try and test it against a random model. Do you significantly outperform the random models or not? Are you at least in the top bucket of the random runs? Because if you're not, well, chances are maybe your model wasn't so bright. Maybe there was a problem somewhere. Maybe you just picked up on one of these factors that we could already see in the random model. You can see if your portfolio really adds value that way. More importantly, if your rules add value. If you add complexity, if you add more rules, you have to get paid for it. That is, you have to find a clear advantage with each rule you add. If there's no clear advantage, it doesn't matter how much sense the rule might make. If it doesn't improve the results of a random modeling, then there's a problem. It is very easy to make a portfolio simulation that beats the index, and that is the point. If these simple simulations can do it, then anyone can do it. Beating the index per se is not that difficult. Final point, of course, is that no matter how good you get, you will not beat all of the chimps. Some of them are very clever, as we've seen, and that's okay, as long as you are one of the better one of them. But if you end up in the middle of the road, in the middle of the monkey strategies, well, then you really didn't accomplish that much with the rules. And that's pretty much what I wanted to tell you about. I notice here, as I fixed the presentation just before going up, I did not fix the URL here, so at least I won't get too many spam mails because you cannot even read what's out there. I'm a very easy guy to find. I am an accessible guy, so feel free to contact me if you have any questions on this, of course. And I've got 2 books, obviously, that you really should go and buy right now. And I'm happy to answer any questions. I think we got about 3 more minutes, if my timer is correct. A little more even. Okay, fine. All right, thank you very much. Yes. Oh, thank you. Oh.
My question is, why did you not put a short screen on? You know, we're worried about the drawdown. Why did you not?
Shorting stocks.
Yeah, to minimize the drawdown during 08.
Different topic, but I believe in general shorting is very difficult. Most people just should not short at all. It's one of those things that look easy on the paper, but frankly not in the end. As you might be aware, I'm also active in the CTA business where we do short stocks or more stock indices. Obviously trend following models in the future space did very well in 2008 during the bear market. But it's a complete misunderstanding that we did well because we shorted stocks. Yeah, we shorted stocks, and yeah, we made some money on that year, but that wasn't the big ticket. The big ticket that year was being long the non-agricultural commodities, being long the oil, the gold, being long the bonds. This was the play, not in the currency market, obviously, but shorting stocks is a problem. Shorting in general in trend following or momentum style strategies tend to lose money or trade even over long enough time periods. It's often a good idea to do it anyway in a very diversified portfolio because it improves the skewness of the strategy over time, but complicated topic. Sorry, next one.
So you're CIO, right? So when someone's pitching a strategy to you, what's the process you put them through, and what is it that you want to see straight up?
When someone is
pitching a strategy to you.
That is correct. I am on 2 seats. We have in-house strategies and we do allocate externally. And I do realize I just said that in public in front of a lot of people who want to sell me stuff, so my own fault. So, well, we don't really allocate to emerging managers. We allocate to mostly to larger existing managers. We want to see that things have worked properly in reality. We want to see the organization. We want to see obviously their offices, their infrastructure. We want to see that they have a proper setup that takes things seriously. The regulatory structure. Believe it or not, there's a lot of companies that don't take those things seriously. They think they can just sit in front of a computer and trade and that's it, and they're done. And it's a decent start, but that's not how you do business. We need to see that things are done properly and that they are professionals, and that's not only about building the models. So we look at everything.
Anyone else?
I you might have mentioned this earlier, so sorry, I forgot.
Sure.
How many different strategies do you actually run? So this is the momentum one, but how many different ones do you combine?
A lot. We have a complicated shop. We do a lot of different models and a lot of different things. We're not only in systematic modeling, so total investment strategies, well, it's very hard to give a normal answer. So let's boil it down to just these things related to what I'm talking about. Probably 5 or 6. But outside of this particular field, we do quite a lot of other type of strategies.
When you were showing some of the random portfolios that were outperforming the S&P, were you accounting for transaction cost at the monthly if you were reallocating, even with the transaction cost and the commission, it still outperforms the S&P?
Yes.
Okay.
Let me add something actually to you here before. You said combining strategies. Just interesting point about that I was asked about previously today that might make sense in this context. You say combining strategies. That's usually a tricky topic because combining different strategies might often make perfect sense from an investment point of view, but it could actually hurt your business. What I mean by that is that many allocators, also goes back to your question, prefer clean building blocks. If you make a strategy, you make a fund or a portfolio that you're pitching that combines these 3 or 4 different strategies, you increase the Sharpe ratio, you reduce the volatility, you increase the returns by this, it looks great. But then you go to a large institutional chief investment officer and you pitch this, and essentially you're telling him that you want to do his job for him. he's going to tell you that it's his job to combine these things, not yours. Now you pitch all of them individual as individual product, and you let him build them himself and decide how much to buy of each, or buy one or several of them. You might have a better chance from a business side.
Okay, thank you very much.
Thank you.